Good morning, traders and investors. Are you guys ready for another pre-market prep? We got Applied Materials, Gap, Ross Stores, BJ, ChargePoint giving out some preliminary results. We also see maybe Manchester United finally gets bought. A couple upgrades, somebody upgrading Expedia, downgrading Canadian Solar. Think you might be a little late to the boat there. We'll get to all the action right here. And of course, we got on my boy Blue. Of course, none other than Blue Putnam. I'm excited to get into today's show. Let's get it started, team. Hit the like button. It's time to rise and shine. It's pre-market prep. Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Conan.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, good morning, traders and investors. We're going for our 14th update in the last 16. That's for the S&P, up 11.5 handles at 45.35, 45.34.75. The buck is off 20 cents here. Couldn't hold still holding that 103.80 level. We'll see if it's a triple bottom or a quad bottom or not. Bonds back up 115 and 20-30 seconds. That's up about a quarter of a point. Crude rebound after yesterday's slacking. That's up 92 cents at 74.01. Gold inching its way back towards 2K, up 430 at 1991.60. Silver in the green, over 24 bucks, making a new high of the move, up 15 cents at $24.08. And Bitcoin futures, they're up $585 at 36,620. Let's bring in Dennis here and Triple D. And Dennis, man, when it comes to retail earnings, it seems like it's always a wild ride.
Everything a wild ride here right now. The markets are a wild ride because what a day yesterday. I mean, you look at the S&P and you think, wow, it was just kind of hanging out. It was kind of a quiet day, but it was anything but a quiet day in the broad market. IWM getting crushed yesterday. A lot of stocks down significantly here. So the S&P we know is so resilient because of the Magnificent Seven. We had Apple strong, Microsoft strong, the other stocks strong. The opposite happening in the IWM. The give back happening here. So we had the big rally 3 days ago, obviously off the CPI. IWM went to 170 to 178. Then the follow through the next day up to 181 and just quietly losing $6 basically yesterday. The IWM, giving back half the gain. So now today, and I mean, this is the story of the day, is the IWM. It's not the SPY because SPY doesn't move. The IWM is trading way up again because the TLT is rallying over $90. So, I mean, S&Ps continue to ignore the TLT, don't seem to be connected with it whatsoever, maybe because it's so heavily weighted those seven. But I mean, holy mackerel, the movement and the volatility in the IWM is incredible the last 3 days.
Yeah, but just like it to just stabilize a little bit. I mean, you have the support, you have the big gap in there from the CPI number, but I just think we got to keep that big, thick line there, the 163 area. It touched it a couple times, so the Bulls are in control as long as that holds. But it just seems like the pullbacks are just so deep that it just wonder how long it can hold up.
And I don't know either. Like, it's like there's so many people who are underwater in all those small caps. It's like, and we were talking, about, the rally and bailing you out. And, some people being bailed out. The last 2 months of gains were gone in literally 2 days. So IWM was sitting not too far from the 52-week low and bang, bang, rallies 12 points while it rallies 7% in 2 days. And people are using it as a selling opportunity. So overhead supply coming into the issue for all the small caps, and a lot of those other stocks are just really beat up. And I can't blame the people. I mean, I'm lightening up into it too on some of these, trashy stocks, the stocks that are loaded up with debt, like the ENPHs of the world. I don't have that one, but it was a significant rally. We're talking about going from 75 to almost $100 in 2 days. Then boom, loses $8 yesterday, Joel. I mean, there is overhead supply issues all over the place here. People who are underwater on this stuff saying, thank you very much for giving me my money back. That's going to be the battle for all these, stocks that are really beat up, because we can say, oh yeah, it's rounding, now we're going to go. But overhead supply isn't an issue for Microsoft. Overhead supply isn't an issue for Apple. Overhead supply isn't an issue for so many, for NVIDIA. Not really. I mean, 500 you could say is major resistance, but it's not like everybody is down in NVIDIA. The majority of people are up in NVIDIA. What creates overhead supply is when people are sitting in these portfolios and they're so far down in these stocks, just hoping to get back to even. The majority of people, Microsoft, everybody who is long is up in that stock because it continues to make new highs every single day. The rotation too, Joel, let's just talk about that for a second, because that's amazing as well in itself. I mean, it seems like Microsoft is starting to just move opposite the overall market. Like, I mean, you get a day like today where stocks are ripping higher here once again. Microsoft in the red. Day yesterday where IWM's getting crushed, Microsoft's up $5. I mean, when did these stocks start having a negative beta with the market? But I feel like Microsoft just trades opposite the market sometimes.
It made a new all-time high yesterday, but more impressive, I like to see, a closing high. It made an all-time closing high by almost $6. $6. That's $6 away. Now you're down a little bit, 41 cents here, but I mean, rotation. Yeah, sell every
Major rotation.
Microsoft.
Can we bring Money Mitch in here for his conversation too? Because he's out there trading. He's out there in these stocks. Money Mitch, what were you seeing yesterday? It's kind of a recap of what we're doing. Sorry we didn't bring you in sooner here. I go on my 5-minute tangent and you're not here. I always want your thoughts here too, because you're down there, you're feeling it. I mean, it's such a mixed market here. I mean, you look at the S&Ps and you think, oh, rah, rah, bull, bull. Q's rah, rah, bull, bull. But then when you look under the hood, what an ugly day for a lot of stocks yesterday.
Yeah, it was interesting. I was noting it too, that there was only one sector that was slightly up, and it was technology, but everything else was in the red. Yet the markets were continuing to hold up. And I'm comparing to from the open, right? Not just overall change. Yeah, that's what I like to pay attention to. What the sectors are doing from that opening price, right? I caught an interesting tweet here by Liz Ann Saunders, the chief investment strategist for Charles Schwab. Of course, this is bringing in here the AAI sentiment that this has been the fastest 2-week jump in percentage from the bulls since, of course, late 2021, which, of course, brought the bear market after that, right? I'm not saying that that's what's going to come, but it's very interesting that we've gone so quickly to that kind of overbought, right? Completely flipping the mentality.
Unreal.
That was just, 3 weeks ago?
Yeah. Not
it's
even.
Crazy.
It feels like it's 2 weeks ago. Maybe it is 3 weeks ago.
Now 3 weeks. Like I would give it like 3 weeks, but Mitch, man, it's incredible.
Mitch, it's unbelievable, really, from oversold to overbought that quickly here. I'm like, when I'm trading here, and you're looking, you're like, okay, well, I have to be very careful. Even when I'm doing like just basic index arbitrage here, you got to be careful with, what's connected to what, because certain stocks just do not participate. And then certain stocks get crushed. And then certain stocks just can't stop rallying, like Microsoft is just doing its own thing and just marching. Microsoft just feels like it's on a march to 400 and nobody's going to stop it.
I rang the register in the retail trade yesterday. Just had to take the gains off because it was just too quick, too fast, right? I mean, in an environment where I can swing trade and make 8 to 10% on swings in 2 to 3 days, I'm going to ring that register every time and take what I can get. I also did a really nice play on the XLE that I opened up not yesterday, but the day prior to yesterday near the high. I have 85.58s, and I'm continuing to watch the deterioration here in oil. Looking to see if we go back into the 60s. That's why I was laughing that the U.S. decided to fill the reserves at 78 when the price was going down. It's like you couldn't have waited 2 weeks or something like that. I mean, you've been waiting like over a year, but this is the XLE, Joel, not XLI.
Okay. I'm sorry, I didn't hear.
No, just short on this oil game. I took some profits yesterday towards 83s and looking to see if the 82.50 kind of daily level can break here. See oil continue to come down and trying to find ways to play it. I'll tell you right now, guys, I did cut like a SQQQ and Apple type of short. I got that yesterday. Was looking to see if we'd see the turn, but it just wasn't coming. And I'm also not going to fight it.
It's so tough to short these leaders because, again, no overhead supply, blue skies, the things just people want to own them. We're coming to the end of the year and they're like, I got to have these stocks on my books. We have a major options expiration here today, too, Joel.
That's interesting.
Which sometimes can flip, but we're just seasonality is just working in this market's favor overall here, too. I just don't know, like, I still think it's the mega cap tech that continues to win. And I know valuations suck there. I wish they all had reasonable valuations. I'd load them all up in the long-term portfolio, but I do think it turns in 2024. That's why I'm like, long term, I'm like, I got to think further than 6 weeks out. I'm like, I think as a trade, I think we keep buying these things on dips. I do think as long-term investments, I'm staying away just because of valuation.
Let's get to Applied Materials. Q4 adjusted EPS $2.12 beats the $2 estimate. Revenues of $6.72 billion beat the $6.516 billion estimate. Applied Materials sees Q1 adjusted EPS at $1.72 to $2.08 versus a $1.69 estimate. Yet look at that price action. What happened here? Of course, there's investigations behind here. Do you guys know a little bit more about that situation? That's definitely affecting the company because it wasn't the numbers here, at least from what I can see.
Numbers were fine. Again, though, you're a victim of, your own success here. You got Applied Materials sitting at all-time highs. Look what they did to Walmart. Walmart, they crushed it on pretty decent numbers. Stocks that are reporting that are at all-time highs, they really got to blow it away. Even Kramer, where Kramer's listening, producer must be listening to the show. Kramer had a whole segment right out the bat on the bar and talking about the bar, and he did Walmart versus Target. The whole segment, Joel, on the bar. And you know what else he said?
You guys
too,
don't
funny,
know
eh?
is I'm the producer
He said,
also.
Listen to this. He says the Target bar was on the ground and they could simply walk over it. Where did you hear that line before? I don't know if I've ever said that before. Oh yeah, maybe I have. Maybe that's the one
Kramer.
I say all the time.
Hi, how you doing?
Hi, producers for bad money. Mitch
is a double agent. Mitch is a double agent.
Are you the secret? Do you secretly work as a producer for Mad Money? You secret, you double agent, you. It's been Mitch the whole time. No wonder all of our content shows up on Mad Money. You're the secret producer. Wow.
Oh, wow. Man, that just
it's getting pounded. Great parallel you made with the Walmart. And Walmart, it's up a buck today, but same kind of scenario there, right up near all-time highs. We're too close to the pre-market low for me to say, yeah, the low for the day is in. It wasn't in Palo Alto Networks, right? I mean, that was just kind of a crazy move. They didn't even get to the 230 area. So for AMAT, I'm just going to look at the monthly low here, and that's still another $4 away. No, it's $10 away, 132.78. So hard to step out ahead. That's still $10 away. Will it be down 20 on this news? I don't think so. But right now, the only number you have is that pre-market low, 142.80, and the top of yesterday's range. Oh, I got the daily down here. I'll change that for you guys in a second. 151.20. I don't think you're going to see that. That was the bottom of yesterday's range in AMAT. AMAT goes splat.
You got to think, though, that there is underneath demand in a lot of these stocks. And I don't know if it comes in on day one. Definitely didn't come in on Walmart on day one. So I think you're watching Walmart's action. This is the same story. Response, good, decent earnings, but just response to the tape. Stocks, the bar, as Kramer was pointing out, as we point out, the bar was super high for Walmart, super high for Palo Alto Networks, super high for Applied Materials, bar really low for Target. It's all about the bar. This earnings season
came after Costco too with that, right? I mean, it does have a
nice Costco got hammered yesterday.
They're hammering those leaders, like the they haven't hammered Microsoft, but Costco goes down because of Walmart, and they're like, oh, boom. And obviously these are pairs. The pairs was always Target. I used to always pair trade Costco, Walmart, Target. Like you could piston trade the three of them, like ding, 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 ding. And Costco and Walmart have been on their own thing. They're just doing their own things, all-time highs, and Target is just like hated. Well, that changed for at least a day.
Let's get BJ's report here. BJ's whole club sales here. Q3 adjusted EPS of 98 cents beats the 96-cent estimate. Sales of 4.92 billion missed the 4.96 billion estimate. And BJ, you should have told me. I would have gone and spent a little extra millions, man. I've been there just last week. BJ's whole sales expects a comparable club sales impact of gasoline sales to range 2% to decrease 1%, increase in Q4 to increase 1% to 1.8%, prior view being 2%. So not as rosy as a report as probably BJ's wanted here. Can this get the lift since it's on the lag?
Joel, you got some levels. Joel will give you some levels.
Okay, I'd just say
This is too small for
64.
me.
Yeah, I mean, you breached 64 in the pre-market, 63.50. So if the Bulls really want to do anything, they got to get a sustained bid here above 64. Right now, that's exactly where it's trading. Things are thin between 62 and 64. I don't see, and there's a couple other lows just under 64, but things open up on the downside. This is a mover. This one had a target on its back going into the earnings because of the because of the Walmart.
It
You
did.
could say, yeah. So it was just that it was almost inevitable, what they did, and with the with the report, it's under pressure. So 64 is sticking out to me. I think that's a good number, short term and long term. Investors in it don't want to see it turn into resistance for BJ's wholesale club.
Let's go to those retailers. Let's go to that Gap.
Oh,
The
that
Gap
thing is gapping up. Remember we used to say
hold on,
Gap,
though.
how many times we could say Gap?
Before we give the numbers here, anybody in the chat ever even been to a Gap in the last year? Let me know. So put a yeah if you have.
Old Navy.
Put a no if you haven't.
Year?
No, it's years since I've been in any of these
I'll tell you right now,
Years.
it's been a long time. So the adjusted
Years.
EPS here coming in at 59 cents, beating the 18-cent estimate. Revenues of 3.767 billion beats the 3.61 billion estimate. Yet they say that fiscal year 23 net sales could be down in mid-single digit range compared to a 15.6 billion year over year outlook.
You
so
could say this run up into the report and the bar was higher, but Gap is such an eternal laggard. It just has laggard and if you look out to 2021, $37 in 2021 is $13. So just because that had $2 rally into it, the bar is still low. So you've got to have a little bit of context more than like the last 30 days of trading here. Bar is super low for this company. Gap is an eternal sell in my book. I've hated this stock forever, correctly hated this stock forever. I do think this just eventually goes back down. I don't know. It's squeezing for a day though. So we'll let the short squeeze have their day.
Just off the pre-market high. I mean, I don't want to call it a high until it's a high. Traded pretty good volume too. So we'll look to follow through the pre-market high. Where's my mouse here? Pre-market high is on a nice number here at 1640, 1650. We'll keep an eye on that. Oh, only 20 cents away. I would, I don't want to be a trader, but I'm looking at like what the Macy's did yesterday. Opened up near its high. So I think it's critical, the opening on this one. If you open up like 1650, 1670, you go to that area and then you reverse and you come back down through the open. Where's their support? You know what I mean? I'm not gonna fault you for buying this off the open and saying, yeah, this thing's going to its next monthly high, which is 18.5. But if doing so, do it with a really tight leash because
I love that strategy, Joel. You taught me that strategy way back in 1999, and you focus on those opens, and they're so important because the open is an event where there's a lot of people long and a lot of people short from that price. It's a huge volume event. And when you see the open come in, and let's just say we'll set up the trade for you just like you just did. Stock opens, let's say it's 1650. If you're buying that open, you don't want to start seeing it go down from there. You want to see it hold that open. If it goes up, your stop goes in at that opening price. So, if it goes up 1650, so it's going 1680, 17, you're holding at 1650. Because when it comes back through 1650, that's where all those open traders start to lose money. And then they start to get scared and start to cut their losses because the opening is full of day traders. And that's why it matters so much. And there is a lot of day traders that actually play it smart and they cut their losses. So opening is a huge event. And I trade these stocks, if I'm trading these stocks the same way, where they open, you don't want to see it breach back through it. And the same thing too if you're shorting the open. Let's say you go short the open at 1650, stock falls off to 1580, and you're like, oh yeah, I'm making the money, man. Starts coming back up and goes back through 1650, you don't want to be shorted anymore. So open is very important when you're trading a stock like this off earnings. That opening number.
I do remember the last time I went to the Gap.
It
was a while.
It was a little over a year ago.
Yes.
And Lisa, I was going by the store, and Lisa asked me to return something.
Oh, there.
So that was it. So I did actually
sales there.
Yeah, there you go. So all right, what else you got for us, Mitch?
Yeah, Ross Stores. Let's keep it in retail.
Ross.
EPS here at $1.33, beats by 11 cents, revenues of $4.92 billion, beat by 80 million. Ross Stores continue to project same store sales for 13 weeks ending in January 27, 24 to be up 1 to 2%. They did raise fiscal year 23 EPS guidance from 5.15 and 5.26 now to 5.30 and 5.36. They revised Q4 outlook from $1.58 to $1.64. Now to $1.56 and $1.62. So really very similar on the guidance there. Maybe the EPS guidance, you can give them a little lift on.
Good numbers. It's not the kind like that are blowing it away here, though. I'm actually surprised the stock's making new all-time high on this. I'd be careful on this one.
It is.
I think what we just said with the gap applies to Ross Stores. If this thing opens 128 and then starts to breach, you don't want to see it go back down through the opening price. So if you're buying this for a breakout, breakouts have to be breakouts. You don't want to get caught in the fake out here. So setting up the trade, and I'm not doing this, but I'm saying if you are, and I'm kind of thinking it's going down, so this is opposite to what I'm thinking. If this thing opens like 128 and then goes 130, then comes back down through 128, you don't want any part of it. So write down that opening price. And if it trades back through that price, then you don't want any part of it. That's my opinion on how to trade this stock.
You just tick 129. That's another $2 here. So this is, at least it's not as close to the pre-market high as Gap Stores. But my focus for this one is, it's the 127 area, and the reason is you had 3 monthly tops right in that area, and then also when you hit 129, you did get a little bounce here at 127. So that's what I look at it. Under 127. You got a gap to fill here. I don't think you'll get it. That 23.93 was the top of yesterday's range. The all-time high in this is 134.32 or 134.22. That was back in May of last year. But longer term too, folks, keep an eye on this 127 because it was 3 monthly highs in a row. And then it had a significant decline off that level. So that's what we'll do for Ross Stores.
ChargePoint releasing preliminary Q3 results and expecting revenues of 108 million to 113 versus 150 and 165 as previously expected, and expects to take a non-cash impairment charge of 42 million. And it looks like they're appointing a new CEO here, Rick Weimer, as CEO and kicking out the old. Seems they didn't like that.
I think this stock's going to go bankrupt. Just my opinion. I don't have no crystal ball or anything like that. I don't have.
But then, if they go bankrupt,
I don't have a crystal ball.
If they go bankrupt, Dennis, then how the hell do we ever get the infrastructure for EVs?
Tesla will give us the infrastructure, but ChargePoint. I mean, you look. There's other ones too. Like, what are the three? There was like the three. ChargePoint. What's the other ones?
You can do Blink.
Blink. No, not
Blink. has the Wall Street bets right now behind
something.
It like crazy, man. Look at that chart.
Blink.
Look at the volume that's there. I'm not messing with this thing.
Well, yeah, but that's Spuddy there, though. That's the cat guy, right?
That's the roaring kitty, baby.
That's the cat guy that's doing that. Meow. So what is there? So give us the ones, because I don't follow all these dog stocks. EVGO, chat, you're good. EVGO is the other one here, too. These are all $2-3 stocks. I mean, all these things look like they're going bankrupt. Maybe they are. The Roaring Kitty's got the one, so it's not going to go bankrupt anytime soon because that guy can really push stocks. But besides him, I mean, EVGO, there's half dozen of these other ones, aren't there?
I'm trying to think of them.
I mean, I don't know. It's just too much money. The infrastructure is too much cost to get it up and going, and then they're trying to turn it around. Tough business.
Yeah, I mean,
especially when nobody's gonna be buying EVs.
There you go. There's the biggest problem.
That's the hardest part. These companies need to raise money to probably survive next year, so that they could finally get to what I think is in like maybe 25.
Rates are killing them too.
Yeah,
What's
no,
the
it's
rate?
not going to help them.
8, 9, 10%. They're not getting an Apple 1.5%. I'll tell you that much.
That's why I would be careful with Blink on both sides, right? You never know when they could raise money as they're getting this spike in price right now. And then one thing that I've talked about with you, Dennis, is that I don't think, EV really takes off until we don't have like gas station. We have EV charging stations where like you go to,
happen.
Instead of you seeing like 8 pumps and 1 charging station, maybe you get to the point where there's 4 charging stations and 4 gas pumps, something like that. When I start seeing things like that, that's when I'll know, we're in this EV boom.
Yeah, we're not at that point yet. And the EVs, honestly, just in 2024, and we're starting to see it, people are going to have less money. There's not going to be a lot. Let's go buy $100,000 or $80,000 or the $120,000 or whatever it was in Canada, F-150 disaster of a truck that is, the Lightning. I mean, it actually looks awesome. I saw somebody in a parking lot, Joel, about 2 weeks ago. I was at the LCBO, which is the Liquor Control Board in Ontario, because they always that's where you go get your liquor in Ontario. And he had the front open, so they call it like the frunk or whatever on the truck, because there's no motor up there. And I was like, that truck looks awesome though. I'm like, do you like it? He's like, oh, I love it. But then I'm thinking, it doesn't tow well, and I tow everything, man. I'm always towing stuff, and it's $100,000 or $110,000. I'm like, I don't know who's going to buy it, but it looks really cool.
I'm sorry, I'm getting a Porsche for that money. I am not.
That's exactly it.
No
you
EV,
spend $100,000,
electric.
You
truck.
Want something like that's like,
I want a 911 turbo, and I will show you guys what to do with that. But yeah, no, not an EV at that price. Just outrageous, guys. That's paying for more than your house, right? That guy's probably paying more for that car than he's paying for his mortgage at his house. But hey,
that's it. These cars. Think about what you used to be able to buy a house for $100,000, Joel. Do you remember like what you pay? I don't know if you want to tell me, but I think about like what I paid for my houses back in the day, like 20. You pay this, and what these houses are going for now. So give you Ontario luck. 2006. Well, in 2000, I bought my first condo, and it was $125,000, and it was sitting downtown Windsor. It was nice, on the 29th floor. And then I sold that, and I barely made nothing, because real estate didn't just go up like that then. And then I went and bought my first house for $340,000, which was a really nice house. Canadian money, so that's like $250,000. But it was a really nice house, 2,700 square feet, nice subdivision, really nice. Then you turn around and you sell it. I over doubled my money on the dang house. But now you look, it's like 600,000, 700,000, 800,000 in this area. Buys you like not even that nice of a house. Like a 600,000 is like almost a fixer-upper now. I'm like, what world are we in? So I mean, how's people get the money to ever afford houses there? And I don't know what they're going for in your area, Mitch. I don't know what they're going for in your area. And obviously, I'm in Canada, so you got to knock off the third, because for the currency. But I mean, houses are just insane, the prices.
Yeah, I would say
it could be one of your best investments, that you can make.
Yeah, but the problem there, Joel,
but at this point, I'm wondering at this point in time, it's such a good point you're making. I wonder at this point in time if these are actually bad investments.
They are, because let's just be honest,
have went up so much, the bubble is so much that people are actually going to start losing money. You think about all the people, I just go buy 3-4 houses, and I make. And if you were buying 3-4 houses 10 years ago, you're a millionaire. You're a millionaire, just like that, because all these houses have doubled in price. But you just wonder if that's sustainable and that can continue.
If you get underwater in these loans, will you be able to refinance them? They're going to want equity.
I don't know.
They're going to want equity. You need equity in the house then to refinance. And so these people might get stuck with 7-8% mortgages.
Or more.
I don't know about you guys, or more. I don't know about you guys, but that's literally what I'm facing right now. I'm looking at it, and I wanted to buy in the pandemic, but I also didn't want to buy a house that I couldn't even look inside of it. Right. And so a lot of people bought this. I don't know how they did it, but we got the biggest move in house purchases in the pandemic, but we'll see what happens, what comes out of that. I think in the long run, we see at least a 20% hit on houses. Then will they be stuck in those high rate
Patrick
mortgages.
looks like he's over talking in euro. It's that euros? Talking in euros. 32,000 first house, second house 200,000. Now it's 515,000.
Yeah,
That's
man,
exactly it.
double if
So
not
they're
more.
like tenfold in 20 years. Some of these houses, like there was houses you could buy for 100 grand. You remember buying houses for 100 grand, don't you? Joel's time, Joey buying houses for 10 grand. He's like in his
No,
ancient times. Just joking. But I mean, $100,000 20 years ago could buy you a house. Now it buys you a car.
Now it buys you a car. Exactly. That should not be. And let's just be honest. The middle class is the one that gets screwed in this situation because there's no way they can afford these houses or these cars now. That's what we're going to
hey,
be
who
able
are
to
the
find
boat
out.
makers? Who are the boat makers?
Oh,
What,
well, if that's the pure
what's
boat
the
makers
stock?
is not, but
Is
you
it
look at Polaris.
Malibu Boats?
What
Malibu
about
Boats or something?
Yeah, but look at a bigger one. Let's look at Polaris, who makes like jet skis, snowmobiles, and all these things. PII. I
Okay,
mean,
you can tell.
I want to say who's buying this stuff in 2024? So this Polaris, and I'm just going to say, looking at the chart here, and I've talked about this before. I've had this conversation before. I mean, it's still holding on pretty well, and people can look at the Benzinga Pro and say, oh, there's some good value here. So I'm just trying to take it. I'm going to take it to another step here for a second. Look at Polaris, and you can say, oh, it's like good value. It's trading with a PE of 8. The forward PE is 9. How can you go wrong? Well, one is people will need financing to buy this stuff because these snowmobiles aren't selling for $3,000 or $2,000. Some of these are 20 grand, 10, 15, 20,000. Jet skis as well. They can go crazy. I don't know who is going to be able to afford to buy these things in 2024. So I think a stock like this is a huge value trap. And a stock like this that rallies towards the end of the year, I think is the gift. So, I mean, don't get attracted and say, oh, PE 9. This is a cyclical business, folks. We haven't been to a real recession for a long time. If the consumer gets tighter and the financing stays tight, and it is tight right now, they're going to have trouble buying jet skis and snowmobiles in 2024. So this stock here, I believe, is a value trap.
Nice move. Keep an eye on 84. That's a double bottom on the monthlies. Your pop up to 95, 11 point move. So if you feel like you want to buy this thing on a pullback here, the $90 area is halfway back, but you absolutely have to lean on those monthly lows. And then on the upside, if you're looking for more upside on this, man, you got to get over 95. You peaked there in October. And you peaked there in November. So let's a quick look at Polaris, and Malibu Boats is sinking too in price.
What is the symbol on Malibu Boats? Small company. What is it?
NBUU.
Yeah, this is really small company.
And
here.
it looks ugly.
And it's bounced. And all this stuff is giving you another out. What this bounce is, again, I don't think we're at the lows where this was the low and you want to go load up on Malibu Boats. On dips, I'm buying mega cap tech. I'm buying, not the sole value. You've got to look beyond that. I don't want to own anything in 2024. Customers require financing. I don't want to own anything that's got a whole lot of debt. I don't want to own that stuff because it's just math, folks. It's not predictions. It's math. People are going to have less. If rates stay up here, people will have less money in 2024.
All right, so let's talk to our chief economist over at the CME, Blue Putnam. He's going to give us his perspective on the inflation numbers. Hey, Blue, how you doing today?
I'm doing pretty good today. Thank you.
Yeah. Excuse me. Thanks for sending over the information here that we're going to cover. And, let's just start right at the top. Let's start with the inflation outlook. And has it already gotten back to 2%?
Oh, yeah. You can flip to that chart. So here's the deal. The reason we're not at 2% on all the metrics, there we go. The reason we're not at 2% is something called owner equivalent rent. And we've talked about that before. I mean, everybody, OER, this is where it's 25% of the headline inflation number. It's huge. And, it's a fiction. You rent your house to yourself, you pay yourself the money, and that money actually gets counted in personal income statistics, and supposedly you can spend it. Give me a break. That's not going to happen. So, I don't like taking things out of the CPI and stuff, but this one's a fiction. So if you take it out, we're below 2%. We've been below 2% for 3 months. We've already hit the Fed's targets. And I think the market over the last couple of weeks has really come to realize that inflation is not the issue. We're not going back to 6-7% inflation. We're in great shape on the inflation outlook.
Okay, so go ahead, Dennis.
So is it like green light buy stocks then? Like if the Fed's done and we're in great shape on inflation, doesn't that just mean the economy is going to boom? What are your thoughts here on the overall economy then?
Well, I think you need a yellow light.
A yellow light. Okay, not green light, yellow light. Caution.
Here's the problem. Inflation, if you take my view that inflation really has come down to a very reasonable level, then what you've got to worry now is about slowdown in the economy. And you also have to worry about the Fed staying higher longer. The Fed doesn't buy the story that I just gave you, okay? They're looking at core inflation is still a little, between 3 and 3.5, all because of the shelter problem. And so they could keep rates higher for longer. And we are going to see a slowdown in the labor market in 2024. I mean, labor force isn't growing as fast as it was. The post-pandemic recovery has really played out. We're going to be creating probably just between 50 and 100,000 jobs a month on average next year, much lower. So you only get a yellow light for equities because the green light is bond yields are lower, so you can buy equities. The yellow light is, well, wait a minute, profit growth is slowing, the economy is slowing. Let's at least be slightly cautious.
So we shouldn't look for the kind of market that we had 2009 through 2021.
Well, we had zero interest rates in QE, and I think they had a huge effect on the market. So I wouldn't go back there. This is an interesting chart. The gray line is the nominal GDP. So that's real GDP plus inflation. The blue line is corporate profits for the whole economy. This isn't S&P. This is GDP data for every company in the country. And you can see in the 80s and 90s, corporate profits didn't grow all that fast. And then after we got 1% rates from Greenspan and 0% rates from Bernanke and Yellen and Powell, corporate profits took off. When capital is virtually free, companies go for growth. And when they go for growth, they get some. By the way, that era has ended.
Okay. Everyone talks about deficits, right? And the huge deficit we have and growing as we speak. How much do budget deficits matter for the economy and the markets?
It's really an interesting question because a lot of people do focus on budget deficits. And the larger the deficit, they think that's an easier, more expansionary policy. Eventually, bond yields would have to rise. Maybe you get inflation, things like that. I don't believe any of that. I don't believe that budget deficits matter very much for the economy and for inflation. What I do believe is that expenditures matter, what the government spends. If the government spends a lot of money, like the $5 trillion they spent during the pandemic, we're going to get inflation. Okay. But that spending, it hasn't totally gone away because we're spending more now, but it's predominantly military spending. Military spending is 90-95% spent in the United States. So it's still been stimulative in 2023. But when I look at fiscal policy, I think we're going to have a very tight fiscal policy over the next 10 years. But I define tight as virtually no growth in discretionary expenditures by the government. Now, if you define tight or loose based on the budget deficit, you're going to think, wow, the budget deficit's getting huge. It's $1 trillion a year already and growing. Interest expense is $1 trillion a year and growing. Fastest growing item in the budget. But the budget deficit is just telling you that the government has to issue more debt. And yeah, maybe that pushes bond yields a touch higher, but it's not a big thing. Okay. It will be maybe in 15 years, 10 years, I don't know. At some point, it's going to be too large and we're going to have a huge problem, but we're not at that stage yet.
One thing that markets need to exhibit for me is like lower volatility. I mean, these bonds are trading like, bonds and related equities to that are just, there's abrupt gaps and it's just all over the place. I like stability. I want to keep rates right here. I don't want a recession. I don't want to see 6%. I don't want to see 3%. Are large abrupt price gaps increasingly, are they going to continue?
Oh, yeah, you put up an interesting graphic I like to show here. This is a pot of water boiling. And, we understand what a liquid is. So we understood what the economy looked like in 2010, 2015, whatever. And we understand a gas to some extent. We understand what a new state of the economy might look like. But man, when you go from one state to the next, you're in transitions. We're in a transition to higher rates. We just finished the transition out of the pandemic. We got climate transitions. We got geopolitical transitions. All of the chaos of the transition is at the surface, the little bubbles. That's where the chaos is. And that's the hardest thing to predict. And so I don't think you have a chance at consistently lower volatility for a while. We got too many transitions going on.
And then will that continue into the FX market? We're not FS experts here, but the entry rate differentials between across the globe here, is that gonna wreak havoc on the markets?
Well, I don't think what happens in FX has too much to do with U.S. equities, but I do think we get a lot of FX volatility. The Federal Reserve was first to raise rates. The ECB followed, but they're going to end up at a lower peak rate. Bank of Japan hasn't even started. They're still at their policy rate is minus 10 basis points, and they will raise rates in 2024, but very, very slowly. So we're going to end up with some pretty solid, wide interest rate differentials. And that tells me that we'll have a lot of instability in foreign exchange.
Okay.
In the last week or two, the dollar's been just a touch weaker against the euro and the yen just in the last 3 or 4 days. And that's because of, the more optimism about inflation and maybe the Fed can cut. But longer term, I think U.S. rates are going to end up higher than European rates and way higher than Japanese rates.
Yeah, let's get into China. Of course, their demographics have been struggling and overall struggling, right? We've been seeing, where's the demand? When is it going to come back? Are we going to see it?
Doesn't. So these are interesting charts. They're called population pyramids. The one on the left is 1990 for China. The young people are at the bottom, working age is in the middle, retirees at the top. 1990 is the sweet spot for a fast-growing economy. A lot of young workers, no retirees. Then you go to 2020. The growth in the young people is zero, and you got a lot of retirees. So, that sweet spot is gone. And then if you look at the future, they actually have a shrinking population in China after about 2025, and a massive increase in the over 65 cohort. It's going to be a slower, much, much slower growing economy. And that's before I even talk to you about property market, debt overhang, 20% youth unemployment, all these headwinds for China. But China had 3 decades where it could grow at 10%. And they built infrastructure. They used all that labor. They moved people from the rural to the urban. They did lots of things right. But now it's not really right or wrong anymore. They're just way older. Nothing wrong with getting older, except that you're a little less productive. In fact, you tend to retire. So, that economy is not going to be a 10% economy. In fact, it'll probably be lucky to be a 3% over the next 10 years.
All right, let's continue. We'll pull down the presentation. We'll get into just a good conversation, right? A lot of people are now, and I even saw the Fed tool pointing to it, is a rate cut in May. Do you think that this is potentially could happen, Blue? And when do you see the famous pivot happening?
Well, the Fed, Jay Powell doesn't like pivots. He's pivoted a couple of times and it hasn't helped his credibility. So let's just say that he wants to be absolutely, totally sure that inflation has been beaten. And I can guarantee you he's not listening to me. So, he's probably going to take things a good bit slower. But the data is, I believe, going to be pretty compelling by the second quarter of next year. And on two fronts. That is, I think we'll be pretty sure that inflation it may not be back to 2% on the core, but close enough. You don't need to keep rates at 5.25%, 5.5%. If you've got inflation down to 3%, you could cut rates to 4% and stay restrictive. So I think the Fed funds futures are telling you, what the market thinks could happen. But I do think the Fed is likely to be a little more stubborn than the markets on lowering rates because of credibility issues. But then when they do lower them, they might lower them faster than the market thinks. So, timing and direction are pretty critical here. I think my timing would be to listen to Jay Powell and push the timing back. But my longer run view would be rates go down further than he's thinking.
Chances of recession in 24. Of course, it's a major topic right now. We've been thinking about it. Will the consumer slow down? Will we run into maybe housing issues? I've made a video on commercial real estate worries. What are you seeing here, Blue?
Well, your video on commercial real estate certainly spot on. They've got serious problems, but they're not serious enough to sink the economy. So I think the economy slows down. I think we'll have like a 1% handle or 1.5% on real GDP for 2024. For me, it's 60% we avoid a recession, 40% we get in one. So it's a pretty close probability situation there. But you have to have something big break that dominoes through the whole economy. So we already know that commercial real estate, particularly in the big centers, it's broken. But if you look, and we knew that the regional banks broke with Silicon Valley back in March but that got ring fenced. And so that didn't domino through the economy. So you only get a really bad recession when something dominoes through the whole thing and people lose a lot of jobs all at once. And that's what I don't see. I just see a major slowing down. So we're not going to like it, but I don't think it's a recession yet. But it's a close call.
So bend, not break, is what you're kind of.
Yeah, that's it. Yep.
I don't think actually, maybe I should go with that. The U.S. economy tends to be way more resilient than policymakers give it credit for. They want to do stuff. It's their job to do stuff. They got to feel like they're needed. And I feel like they don't give the economy the resilience that it really has. We have a very resilient economy.
Sure.
Yep. Well-rounded economy.
Canada's already in an official recession, last 2 quarters of negative GDP. So, it's different, but it seems like in the US, and maybe I still think it's a lot to do with mortgages that everybody's sitting on 30-year fixed, and the interest rates just don't impact their biggest expenditure as much as it does in other countries. I mean, Canada has, you get your neighbor, oh, my mortgage is coming up next year, or my mortgage is coming up in 3 months, and they're starting to cut back spending because of that. I mean, maybe the U.S. just stays resilient because of these 30-year mortgages.
Well, yeah. I mean, if you bought a house in the last 12 years, your mortgage is in the 3% territory, and you're not going to sell that house. Now, if you're in Canada, your mortgage is a floater, and it's floating up.
Half the people are floaters.
So, Canada gets hit much harder than the U.S. on this situation. But housing has already impacted durable goods. You don't, when you buy and sell houses, you buy and sell appliances and all kind of other things that go into houses. And there is zero inflation in durable goods right now. So it's had an impact, but it's just the question is it enough of an impact to cause a recession? It's definitely had an impact.
The $64,000 question brought up by the managing director and chief economist in my old stopping grounds, the CME Group. Blue, just such an education in asking you these questions, and we really appreciate you joining us here on Pre-Market Prep. We'll be dialing you up once more before the end of the year, so no vacations for you, Blue.
No vacation.
I got one coming, but I'll be back.
All right.
I love it,
All
Blue.
right.
Always good to have you. Thank you. All right,
Thanks,
we'll get back to it. Always good to have Blue. I love that he comes not only prepared with the presentation, but you guys see
awesome.
it's a conversation.
Wow.
He's always on point. It's always great to have him.
Bottom line, awesome.
Okay, we're leaking a little bit.
Yeah,
We're
we are.
leaking. Oh
The
man, I
housing
sold my
housing
ass
starts, I
QQQ
think,
this
building
morning,
permits.
man.
We had an
What
830
was it?
building permits number
Yeah,
here.
I
which
showed it on
made-
the screen.
Yeah,
It
can you
was
show it here again?
1.48
So
versus 1.45.
a little bit up. A little bit up. Is that enough to spook
Yeah,
the
because we're
TLT
getting
a
a
little
slight
bit?
tick down, right?
Well,
Slight tick
TLT
down.
spooked under 90 again. So we spooked back under 90.
TL.
The critical 90 level, we spooked under it on that thing. So,
Yeah.
I mean, again, as TLT goes, the IWM is going, except for yesterday when there was this disconnect here, which is somewhat concerning. And maybe we should talk about the disconnect that the IWM and the TLT had yesterday. We talked about it on the closing print here, Joel, but we haven't mentioned it on pre-market prep. TLT had a great day yesterday, and IWM did not. And that is concerning in itself, because one thing has, obviously IWM's been connected with the bonds because they're worried about rates. But a concern would happen is if the IWM starts worrying about the economy more than the rates. And I'm starting to think that is starting to occur, that the IWM is starting to worry about, what if we do go into recession? What if we get higher? What if we have these rates elevated for a prolonged period of time, coupled with slowing growth? What happens then? IWM, you ain't going to want to own it then. I actually lightened up a little bit of my IWM long-term position. I'm thinking about lightening up more into today's rally in my long-term. I want to not own the small stuff, because if rates are going to be higher for longer, and I think they are, I don't think we're going back down to 1%, 2%, 3% interest rates anytime soon. So I think they're going to be up here for a while. I think small caps are going to continue to suffer into 2024. And you're getting this recent rally, which is bailing you out of a lot of stocks.
We'll see if we get the turn today. I think that's what we'll be kind of keeping an eye out for, especially like big cap tech, right? When will that continue? Or will we continue seeing that weakness that you pointed out earlier in the show, Dennis, about Microsoft starting to pull back? That's why I was looking at Apple also. I'm already out of the trade, so I'll kind of talk about what I saw there. Is yesterday there's a gap fill from the date of August 3rd.
Yeah,
And
we talked
about that. Is that playing as resistance here? And that's what I was looking at. That's why I shorted it yesterday in the 190s, thinking that maybe I could risk off of that level. I cut it already because, this morning seeing AMAT go down so much, the market not even just straight shrugging it off. The bulls are strong. That's 1,000%.
The bulls are strong in certain stocks.
Yeah.
And we've got to continue to we can come in and just say, the blinders and we're a SPY and the Qs are making new all-time highs and what a resilient market. But there are half the stocks. Remember, I tweeted this out just, and again, maybe it's not the case because we've come up here, but just before we had the rally, of the S&P 500, there was only 220 stocks that were green on the year and 280 that were down, despite the S&P being up 13%. So your average stock is actually not performing well. Now, we have seen a significant rally in all of those stocks in the last 2 weeks. I'm just throwing it out that maybe the significant rally is another chance to lighten up the stuff that's burdened with debt, consumers needing financing to buy their products. Maybe this is just another chance to get out of those stocks, maybe move to the sidelines for a bit, but eventually move into stuff which is safer. And you know what is safe is the Microsofts and the Apples are safer. Not saying those, valuation's an issue, but we know those companies are not going to be in any trouble if rates stay up, because 0% financing on the iPhone continues despite what we have seen happen in rates. And I mean, their products are cheap enough. It's not like you're going and buying a $100,000 car at Apple. No, and maybe that's why Apple never got into cars. Maybe they were the smart ones.
Yeah.
Maybe they actually stuck with something that the consumer is unwilling to give up. And I mean, you can be on, out of money completely. People will not give up their iPhones.
Nope.
It's their one luxury item. And you know what? It's a cheap luxury item. You go out there and you buy a new phone for $1,300. That is a cheap luxury item that just makes me feel better about my life. People will not give those up. And
everyone
this is where
has
I've been
them.
maybe wrong on Apple because valuation has turned me off. But the resilience here tells me that in higher rates, Apple still works. Now, if rates fall off a cliff, and their only reason they're going to fall off a cliff is if we go into a recession. That's why they're going to fall off a cliff. But because the Fed ain't Powell ain't coming in, why? If the market's at all-time highs, why in the hell is he going to lower rates? It would make no sense whatsoever. He'd be creating his problem again. So if you really believe that rates are going down in 2024, the only reason for that is that the economy falls off a cliff. And I think that's going to happen. But I think you've got to be very careful with all of these stocks that are burdened with debt. And I think you're getting a fantastic opportunity right now to lighten those stocks up.
You know, one other thing too about Apple. What was the other thing that they were really going to be big into? And it was Apple TV, right? And
Yeah.
I mean, they still, I mean, they have it.
I
It's
think
not
they're
a focus.
slowly building it, Joel, which is
But look
the
at
right
what a
move.
debacle like TV it's streaming in now and everything. Look at the competition. I mean, it's
Honestly, I think they got Disney beat here in their product versus, let's say, Disney Plus. So if they can get second place there and compete with Netflix in the long
yeah.
term, that's not a
Yeah.
bad area to be in.
Ooh, look
Another
at
thing
it.
that, to tell you the truth, another thing that most consumers won't give up, right? Most consumers don't give up their streaming services. They keep them. It's crazy, but they're willing to pay the $15 a month.
Because it's a small luxury, it's a small ticket. So here is your
Yep.
formula, I believe, for success in 2024. Owning stocks of companies that have small ticket prices on their products. Smaller ticket prices. Walmart's obviously probably a good one. Smaller ticket prices. Because people are not going to be able to finance solar projects. They're not going to be able to finance automobile purchases. They're not going to be able to finance jet skis and snowmobiles and all this stuff. This is just, a lot of the markets is just bloody common sense. You know, we can look at charts and we can look at all this, but in the long run, common sense actually works. I would say, you know, I'm a relationship-based trader, but I trade a lot on common sense. And, you know, like the whole COVID thing, Joel, that was common sense. In January, we knew it was coming in January 2020. It was like, just open up Twitter and look at what the hell is coming at us. And everybody's like, oh my gosh, March happened. And like, what's going on? We called that for 2 months ahead of time. You know, think about, you know, like Dumb Money, you know, Chris Camillo and stuff. He makes a lot of money by using common sense. What's hot? What is people talking about? What's, you know, because the stock market is stupid and doesn't price in anything. It is stupid, folks. That is why you're able to make money as an inefficiency trader, because the market is just stupid. So, I mean, we got to look, and sometimes you got to take the blinders off and look at what's happening. And I've taken the blinders off of Apple and Microsoft, and I can see why these stocks, not saying I got to go buy them today, but they'd be on my shopping list on dips here now, because the products that they sell, that Apple sells, are cheap enough to go through a recession.
Yeah, I always say you got to understand the current environment. I think that plays right into what Dennis is saying. Let's take a look really quickly. I did want to do a little ticker time, so at least one or two tickers here for you guys in the chat. I still have Pan W mentioned right off the hop as soon as I mentioned this.
That's a
Let's
good
go to
one.
Pan W. Let's take a look at this. Recent, they've been pushing, but then the earnings came in. The earnings really weren't bad. Of course, we've been talking about how the leaders have been getting hit on their earnings. What do you guys think about this chart?
My comments are, you know, you're $8 above yesterday's low. So I think on, you know, buyers are going to be scratching their head. They're like, I should have been out there in the pre-market yesterday, or I should have been out there early. So I think you get a couple higher lows in here, maybe a few days of consolidation and a strong market. You get back into this gap area. But if you were using your dailies and you didn't really focus on anything else, you had a low at 233.81. You hit 34.15 yesterday, and you're trading $8 above it. So it might have been, you know, just the 1 day dip here, but we'll see. We'll see if we can back and fill in here. Palo Alto
House
Network.
of Mouse, Disney.
Holy
is it
mackerel!
top here?
Value Act. I didn't see that.
This has nothing to do with the earnings, right? This is jumping onto the ESPN bets game, the 15th. Now we're past it. They gave the little nice press release on that. Get ready. I think this is coming down today. I'm going to be coming after Disney today. We'll see what happens.
Value Act got in job.
Short
Disney.
Short Disney today, man.
The main thing
Buy the rumors,
here,
sell the news.
I have a trading position on Disney, full disclosure, which I will be selling at the open here. But it's small. But I just say the reason Disney has rallied here isn't, you know, the awesome earnings. It's the target. It's the bar. It's just the fact that leaders to laggards, laggards to leaders. I mean, we've seen some of the leaders getting hammered lately. Disney is the official laggard of this market. It was lagging before any other stock. I mean, you know, think about the Disney collapse. It's all they would talk about on CNBC because there's nothing else going down. Disney is the ultimate laggard here. The laggard trade has been on. It's holding up here. That trade will eventually reverse, though, is the problem. So Disney, massive resistance up on $100. I think rallies to be sold still in the house.
Dennis, you remember when you were talking about consistent buyer, like in the lower 80s? Remember that? There was like a point.
And that's a huge level.
Yeah, well, I didn't realize. I looked at the move on Wednesday. Value Act has built a position in it.
Yeah,
and they're good.
You think that was them?
Yeah,
that I was
yeah,
seeing.
they're
We
good.
were seeing on
Value
the
Act.
tape where, like, you could see the big buyers that were in there. You could feel the buying pressure down there. Value Active is a big. How many shares? But again, it's not like that Disney trades huge volume, so probably in a couple days they can slowly get into their position.
All right,
Okay,
time to wrap it up here.
Yep. Yeah, let's wrap it up here. We're up 9 handles. We peeled back off the pre-market high. It's a really good level, folks, because we hit 41.25 off the PPI number, and we just hit 39.5. So you have a potential double top, but the propensity of the market to make close on the highs or lows for the week. That will be the key there. We seem to be getting a little bit at mid-range, and no chance of going red until we go red, and that's at just below 1 tick below the pre-market low. So that's all I got. Dennis, what do you have?
Options expiration here today, this morning. I had a lot of buy-in balances across the board 20 minutes ago. A lot of those have flipped to sell. So I think you've had a few people caught and saying, oh, we're really going to have a gap. We're up here this morning. And they're starting to leak them here, and those buy-in balances have vanished now, and a lot have turned to sell. And again, they could flip back to buy. This is, options expiration. You can't look at the opening imbalances really with a lot of, you can't look at it like hard because they move around so much on these days. But you'll have some wicked opens. There is, movement here. There'll be some stocks that open too high, some stocks that open too low. Typically, from a trading perspective, as an inefficiency trader, options expirations are usually my best day of the month because you have a lot of stocks. Maybe they should open here. They open here, I get short. They open here, I get long.
Who would be the best possible guest to have on Monday?
I would think 2. I'm gonna think 2 people because that's how good they are. I would think Tim Quast after option.
What do we had a lot of earnings in?
A lot of earnings. Retail. So
Ryan Craver. Yeah.
There you go. You see?
Love me some Ryan Craver analysis.
Hey, that's going to be fun. Definitely.
All right, everyone have a great weekend.
We'll see what happens. Like always, keep up with Joel Alconen on the closing print. Dennis Dick, Triple D Trader. If you're not following him, what are you guys doing? Get after it. All right, Dennis, go do what you do best, my friend.
Thanks,
we'll see what happens. All right, guys, we'll get you guys over to live trading. That's coming up next. Like always, I'll be coming into it. I've been switching it up a lot. I've been trying to stick to more of the swing trade game. So if you guys want to check some of that action out, not just day trading, but it's also swing trading, that's going to come up next. That's live trading with Benzinga. Ryan and I have been coming after it, riding dare I say it, a 4-day winning streak. Let's see if I can make it 5. Who knows? We'll find out today. Like always, you guys can keep up with everything right here on Benzinga. Later today, I'll have Start Swing Trade, of course. That's at 3:30 p.m. Eastern, where I talk about the sectors and the industry rotation. That's where we really try to catch things. We will see what happens today. How you find out? Well, just stay with us, team. I'll see you guys over on live trading starting up next.